Shukla is here with us on the phone line. Shukla, thank you very much for your time. Before I ask you on your take of the economy, first I'd like to understand on the commentary coming out of the MPC minutes yesterday. Very interesting mix of various members, but the broad message was that because of the spike in inflation, it appears that the rate cut cycle could pause. Do you think market will worry about it, or the bond market? How is it reading that?
Thank you, Ajay. I think when we look at the minutes and also what the governor said in the post-policy conference, if you put both of these together, what comes across is very clear. The job of the central bank in general and the MPC in particular is to worry, right? It won't be an exaggeration if you say that they're paid to worry. And the context is that the MPC mandate can be interpreted as a pure inflation-only mandate, but I think that is conceived for normal times and not for times such as these, such as this pandemic. So according to me, I think a lot of people have interpreted it as extremely hawkish or very hawkish. I would think they're pretty balanced. In fact, to me, when I read the minutes or interpret the minutes, what it shows to me is that if there is one thing that the MPC is worried about in unison together, it is growth. I mean, if you look at Dr. Patra, he clearly says that this year we will see the deepest ever contraction, right? Similarly for other members, and everybody has spoken about how the outlook is grim and the recovery is going to be slow and protracted. So it doesn't matter which member you look at, everybody is saying that growth is going to be a concern. And I think the other point to note is the RBI is not given a numerical growth forecast, but I think it is very clear, especially through what Dr. Patra has said, that it is going to be something like we've never seen before. Where the MPC is uncertain, it is on inflation. And again, if you look at what Dr. Patra says is very instructive, it can go the 2010 way or the 2016-17 way. And I think there are multiple issues when you look at the supply side. So it's very clearly what they're saying is we don't know where or how inflation is likely to end up, say 6 to 12 months from now. It could end up, very high or very low. He's also tried to give us this bad outcome example of 2009-10, when coupled with stimulus and a buildup of domestic inflationary pressures, inflation expectations, etc., and then a bad monsoon, inflation spilled over into other components, and it took more than 13 consecutive hikes to bring it under control. Right now, when you look at inflation, it is very clear it is supply side driven. And if you look at the way things are panning out, there is flooding across the country. Earlier, it was only confined to the eastern parts of the country, say Assam, Bihar, etc. Now, multiple states are experiencing that. Then there is this cost push pressure from the government. High taxes on petroleum, etc., telecom charges, higher raw material costs, basically steel prices and gold, etc. So I think if you put everything together, it is clearly a supply side issue that has come about, and that is worrying the MPC at a time when they are very worried on the growth bit. Also, one distinction I want to draw. Globally as well as in India, the worry is the same, potential inflation. Because if you recall, the RBI has infused more than 9 trillion rupees already. But the difference is globally it is because of huge fiscal-led stimulus, right? But in India, it is largely the supply side issues or the breakdown on the supply side. Now, I think over the next couple of months, next 2-3 readings will be very, very important to see how this pans out. And also, I think a bigger issue is, how should we judge the CPI basket? It's very, very tough. Food has become the predominant component. And should you give an excessive weight to that component or inflation that is being caused largely because of food and supply side issues? I think that is the real question in terms of judgment. I think it's very clear the RBI stance has remained the same. But the key question is, will it change in the coming months in light of the new data? And remember, when the MPC minutes were written or collated, the RBI did not have the July CPI reading of 6.93%. So I think reading all of these together, I think MPC is really being forced to worry about inflation because of largely supply side issues. We have issues with the CPI numbers themselves. I mean, how do you assign the right weights during a pandemic, etc.? I think let's probably wait for a couple of months to see how this pans out. And also, a major change which is likely to happen, we know the term of this current MPC has expired. The terms will be revised for the MPC. There will be new members coming in. So I think we need to wait and watch for how things evolve. But right now, I wouldn't be very, very worried in terms of a change in stance from the RBI. I don't even see them going back to neutral anytime soon.
Right. Mr. Shukla, before I let you go, one more view I would want from you on the macro front. It may not be immediate. It may sound like a market question, but I want to understand from your economists, wearing a hat, that how are you looking at the global risky asset prices getting inflated? Is it largely because of the ample liquidity which is flooding from global central banks, or is it justified? Because there is a very big loud cry out there in the market that the reality on the economic front is taking a far departure from the way asset prices actually are moving. And also, if recovery indeed starts happening, say 12 months far out, and global central banks start holding back the liquidity or start tapering back, are we risking a taper tantrum kind of a situation as well down the road?
So you're right, Jay. I mean, this dichotomy clearly exists, and not just now. I think if you go back, say, end April or early May, I think you clearly saw markets really going the other way. So the real economy versus the financial market, I think the dichotomy has been just going up constantly, and largely because of the liquidity support, which is understandable. And asset prices have really reacted to the liquidity that central banks plus the fiscal authorities have really thrown. So the response so far has been from monetary and fiscal side globally to throw more money at the problem, because we don't really see any recovery right now. If you look at any major forecasts from multilateral agencies or private forecasters, nobody really is seeing any sort of real recovery in the real economy. But the kind of money that has been thrown at this problem, you are seeing that result into higher asset prices across the board. And we've seen even the commodities beginning to really move up. But will this sustain or will this really move up? I think you mentioned about taper tantrum. I would like to probably say we should be prepared for a vaccine tantrum as well. For example, if, say, by the end of the year, a vaccine or two is announced, I mean, the efficacy, etc., will be really seen or tested over time only, and we'll know that only later. But the moment some of these get announced, you will see some bit of that reflect in asset prices again. And instead of really falling, you might really see them move up in the short term. But as you said, for a period of time, after judging the efficacy of the monetary on real, and also when the dawn that some of this liquidity has to be taken back, I think the market would react, and therefore I'm saying we should also be prepared for something like a vaccine tantrum. So yes, this is likely to, the dichotomy between markets and the real economy is likely to persist, because and in any case, real numbers, I mean economy numbers, will reflect or manifest with a lag, and I don't really see these really improving in a hurry.
Right. All right, Mr. Shukla, we'll let you go on that one. Thanks so much for your thoughts talking to me today. That was Sachchidanand Shukla, but